Well, we do think that oil will potentially get down into the 20s near term. We expect production of oil to continue to be very, very high out of the U.S., out of Brazil, out of Russia, and that will probably bring oil prices down into the 30s, maybe even into the 20s. We do think that by the end of the year, production cuts will occur, bringing oil prices back up to maybe $75 or so, but near term, we do expect further weakness.
Well, what does that mean for global growth and therefore commodities, currencies rather?
Well, I think it's great for growth. It's a windfall for consumers. We tend to like consumer staples in the U.S., consumer discretionary, and believe that it's a big windfall for global growth.
The global growth story, though, on the other side of the coin, yes, it's acting like a tax cut, certainly for many countries out there when you're talking about global growth. The bigger picture, when you look at the bigger picture and you take a step back, a lot of the analysts were telling us yesterday, certainly, that it's a negative for global growth. It's a negative sign, I should say, for global growth because you just don't have the demand there. Is that something that you're concerned about?
I think it is. I mean, the real engine for growth right now is the U.S., and everywhere else seems to be slowing down. Euro area, Japan still sluggish, and even China seems to be slowing down, as evidenced by the recent easing. So we think it is a windfall for consumption, for global growth, but in a slowing environment outside of the U.S.
David, I mean, let's talk about this and the implications for the casualty currencies. I mean, strip out, of course, the expectations on when or if the Fed increases interest rates. If we saw $20 oil, how painful would it be getting for some of these commodity-related currencies? I mean, let's face it. I mean, at $50, you know, Russia's, well, it's not bankrupt, but I mean, it's pretty close to it. I mean, its debt is almost at junk status. So what would that mean for some of these currencies?
Oh, it would be very bad for a lot of these countries that are oil producers. It would also be quite bad for you know, the high yield sector in the U.S., which is over 20% energy related. You could see, we think that a lot of those companies are well hedged for the first part of 2015, but you look into later part of 2015 or into 2016, it could be some tough times for some of those high-yield energy companies.
And let's assume that this $20 oil that Citi's put out there does in fact eventuate. What would that mean for Fed policy, and would that keep the dollar at bay in terms of its acceleration that we've seen over the course of the last few months?
We think the dollar strength is going to continue regardless, and we're also looking for the first Fed rate hike in the fourth quarter. We're expecting further hikes into 2016. But you know, that could provide further strength for the dollar over that period.
Now, in terms of the Aussie dollar, let's talk about the Aussie dollar. You know, we of course have had these concerns, especially coming through out of the US, about what's going on in China, domestic demand in particular. You look at the import numbers that came out on Sunday, PPI numbers that came out this morning. What's your view on how that's going to impact the Aussie going forward?
We think that there is further room for China to ease, and that will continue throughout this year. On the Aussie dollar, we're probably getting close to fair value, though we're of the view that that could overshoot too, and maybe get into the 60s or even lower as an overshoot. But clearly, the slowness in China will be a factor facing impacting the Aussie dollar. But at the same time, we do expect fairly aggressive easing out of the China PBOC.
So $60 potentially for the Aussie. Dollar strength story, I would imagine, as well. And parity potentially for the euro.
Correct.
Okay, wow. And $20 for oil.
Near term, we do think that would be an overshoot due to continued overproduction, but then that could reverse by the end of the year as well. Okay.